Welcome everyone to our Friday night MCFAM seminar. This is I'm not know which number it is this for fall 2020, but this is our almost Halloween version of it. And very pleased tonight to bring you John Dodson, who is one of our esteemed instructors in the MFM program and has been since it started. And I recall very fondly working with John before the program even started on developing the curriculum and having debates about what should be included and what shouldn't and how we should structure it and these sorts of things. So John's been a longtime supporter and instructor of the program. Uh, John has been involved in quant finance, to my mind, probably what I would say before it was cool. Is, is the way I would describe it. So if you ever want to have a conversation about quantitative finance, or you want to understand some, historical perspective or some very philosophical or deeply theoretical perspective or anything on those natures, John is always a great person to talk to or have discuss the topic. John's done a lot of things. I think I first met John at a GARP meeting in St. Paul, like way back in 2001 or something like
Oh
that.
my gosh, yeah, it could be.
But then I later worked with him briefly at Ameriprise when he was working in investment risk management, and I was working on hedging variable annuity guarantees on the insurance side. But we were on the same floor for a while, and uh, then John's gone on to the Options Clearing Corporation, but way prior to even prior to that, way back in his history, he was in Switzerland and in London, and now he's in Chicago. So John's been around the quantitative finance market for a long time, and his incredible deep knowledge, both from a theoretical and from an actual practitioner perspective, is highly interesting to me and something that's I've always appreciated. So, without any further ado, then I'm just going to turn it over to John.
Thank you, Gary. Hey, I really appreciate the opportunity to talk with a wider audience. This talk actually started almost as a mistake on my part because since I teach for the MFM program, I did a orientation recording. And Lori was very explicit about the rules, and I broke the rules by about 12 minutes. So Lori said, cut it. And then Gary said, but bring it back as a MCFAM talk. So here we are. So I'm going to go ahead and try to share. I'll monitor the chat. If you have questions, go ahead and drop it in the chat. That's probably the easiest thing to do. Then hopefully we'll open it up at the end. Gary, how long do I have normally?
Yeah, we normally go until 8:30. However, so normally people target to leave 10 minutes for questions at the end.
Yeah. Okay.
So that's your guideline.
Okay. All righty. All right. I got to get the chat open so I can see what's going on. There we go. Okay. So the title, I hope I set up the title to be a little bit provocative, and I do actually want to speak to these footnoted items. So I wanted to give you, it's really a couple of different things. I want to give you my sense of the trends in applied mathematics. So these are decadal trends. These are not like trends from just last year. I also want to give you a sense of the trends in roles for quants and quant hiring. And those are also decadal, but they're more, from the 80s forward, basically the life that I lived in finance. But the main thing I want to do is to provide motivation, in particular motivation in support of the study of mathematics as it relates to finance. And the reason I think that this is important is I think mathematics provides a framework for thinking that is ultimately it's ultimately valuable in the applied domain, and it's valuable in a sort of non-trivial way. And I want to give some examples of that, talking about both Bitcoin and the fashion around big data and some things to watch out for, just as examples, and we can talk about other examples as well. So my thesis, and this is largely a summary of the abstract that you already got, but my thesis is that mathematics has thoughtfully assimilated over the last 80 to 100 years a fairly complete description of the basics around probability, statistics, and information. On the other hand, over the same time frame, or perhaps since the sort of 50s, there's obviously been an explosion in computing technology during the Moore's Law era. For those of you that have seen previous talks of mine, I ended the Moore's Law era about 10 years ago when we got to 22 nanometers. So anyway, the point is that an outsider looking at kind of STEM in general would see the computer stuff and say, oh my gosh, computer technology has just been revolutionary inside of finance. But I actually think that what's happened in finance is actually much narrower than just computing technology in general. And I could even give a whole long talk on sort of which parts of innovations in computers have been relevant to finance and which are maybe less so. But I wanted to give some explicit examples about these, what I'm calling quieter innovations in mathematics and how they've affected the finance industry. And the main thought behind that is, because mathematics is mostly about kind of how to organize your thinking, that by understanding the best way to organize your thinking around, for example, probability, statistics, and information, it gives you as a practitioner an excellent foundation for building something that creates lasting value. And there's lots of ways, particularly with computers, to just stand things up and see how they fly. And we've seen now a couple of booms and busts in technology. And that's kind of the nature of that, is it's easy to sort of throw up something and see how it does, but some ideas have survived and some ideas have not survived. And I think that ultimately that some of that was predictable. So I'm trying to encourage you as practitioners or as aspiring practitioners to notice those patterns and to try to learn from that. And I think a lot of it relates to whether or not the foundations are proper. Okay, so the way I've got this talk organized is I want to spend a few minutes on both probability, statistics, and information, and some of the ideas that I've come across in working in applied math from these domains. And then I want to do a deep dive into Bitcoin and talk about, in particular, how Bitcoin has succeeded in certain domains, but it's largely failed in its principal goal, which was to become a currency. And I think there's a reason for that. And I want to explain that and defend that and use that as an example of how, its failure probably could have been predicted. And I think its failure was predicted to some extent. And I also want to talk about big data. And big data hasn't failed yet, but it's in the process of failing. Well, it depends. If you ask the Europeans, they would say it's already failed. But over here, it hasn't failed yet. But I think also its failure is ultimately predictable. And if we have time, we could talk about some other examples. But then the other thing I want to do, again, this coming out of a talk I gave at orientation, is to talk about sort of my view of the evolution of the role of the quant, which I hope isn't too much like war stories, but I wanted to give you a perspective that I think is fairly well established at this point. And then to give you some ideas as to where we stand at the present day. And hopefully that takes us up to about 8:15. Okay. So probability as a sort of I mean, I haven't like looked into the history of the word probability. Obviously, people have been doing probabilistic type calculations and trying to quantify uncertainty in one fashion or another for a very, very long time, probably going all the way back to the Egyptians. But um, but it was never really, not until say 100 years ago did probability really have a chance at being considered part of mathematics. Um, and which I think is interesting. I think the sort of oldest kind of main result in probability is probably the law of large numbers. And the law of large numbers, I don't know how old it is, but it's very old. And it basically says that um, there's a mechanism that causes what we now know as random numbers to collapse to regular numbers. So it provides a sort of bridge between the world of random numbers and the world of regular numbers. So that had sat out there, but it's not a particularly interesting bridge. It just simply says, you know, if you're calculating an average and you have a larger and larger sample of the distribution from which this thing is that you're calculating the average, that under some very weak conditions, that average will converge arbitrarily close to the actual number. So that's sort of interesting in the sense that it suggests a link between these two different objects, between random quantities and non-random quantities. But in and of itself, that really wasn't enough. I mean, okay, numbers are numbers, right? Like we, as kids, we learn the difference between counting numbers and integers and negative integers. And okay, fine. So now you have these sort of random numbers that under certain ridiculous circumstances converge to regular numbers. It's really not good enough. The first sort of result that got kind of good enough that it sort of piqued the interest of mathematicians was the central limit theorem. And it probably was Laplace's illumination of the central limit theorem, not even the original central limit theorem, which dates to the 1700s, which was in the, during the Industrial Revolution in the early 1800s. That's when the central limit theorem came up. And this was kind of interesting because now it was talking about a bona fide random number that was still a random number, that was now converging to some kind of canonical random number, sort of irrespective of the nature of the original random number. So again, the idea with the central limit theorem is that in the process of converging in the law of large numbers to its mean, the sample mean will converge arbitrarily close to a normal random variable, which is a random variable whose probability density is given as e to the minus x squared. So a non-trivial thing that's still a random number, but now it's like, okay, now we have different ways of generating the same random number from, an infinite number of mechanisms. So this began to make probability look interesting to mathematicians. It was still mostly about counting, but it had these kind of oddity results. It had this central limit theorem thing, and then of course it had the law of large numbers. And it really took kind of the fruition, and I don't know exactly what was happening in the sort of the world of ideas back in the 1930s, but it was something about, in particular, the work of Kolmogorov and his colleagues, where he said, it looks like this probability stuff might be close enough to being mathematically interesting. Let's take a crack at trying to put a foundation to it. And in particular, to do that in the context of measure theory. So this probably had more to do with what was going on in measure theory at the time. And that really, over his lifetime, he did so much to sort of make probability interesting. First, initially, it was very provocative in the sort of Russian and French intellectual circles, but then eventually it kind of crossed the Atlantic and across the English Channel and the Atlantic, and started to look interesting to the analytics side of the world as well. But I would say that the thing that really sort of cemented probability's role within math, and I'm noting here that its official classification is MSc 60, which is under the 2020 mathematics classification scheme. So it's sort of like, it received its license as mathematical topic 60. Probably, I don't know exactly the date, but it was probably in the 50s or the 60s, something along those lines. And it really had to do with something that not everyone knows, something that I teach in this class, but not something that most people would know, and that's the universality of the Pareto distribution, which sometimes gets called the law of small numbers. And this is sort of like another central limit theorem result that says that if you look at the distribution of the maximum of an IID process, and there's lots of interesting things when you're looking at the maximum that allow you to relax just exactly how IID this thing is, that the distribution of that maximum will conform in the limit to a Pareto distribution, which is another non-trivial distribution. So the fact that we can say something, and the fact that we can say something actually quite detailed about essentially any random number in terms of its large results, and that's why they call it the law of small numbers. It's meant to explain kind of the nature of extreme outcomes. So this is in the context of what is called extreme value theory. And the main results for extreme value theory are, well, the convergence to the Pareto, but then there was actually a whole sequence of works by French, American, and Russian mathematicians that kind of led to this result. And there was also a sort of synergy at the time going on with power laws and the zip power law, and there was a sort of fashion that people had started to notice there were these trends in nature, and were wondering about kind of this universality that was sort of sitting out there. And I would say, in my opinion, that it was really that universality, this Pickens-Balkema de Haan result about the universality of the Pareto distribution that sort of cemented probability. And of course, there's all of the work that I haven't listed here about stochastic processes and what's the mathematical object for a stochastic process. In particular, you take the sigma algebra and you introduce it as a filtration, which was another idea of Kolmogorov. The filtration becomes essentially the definition of the knowledge conveyed by the process. So there's a lot of really interesting things going on that side as well. But I think that the universality of the Pareto was probably the one that kind of allowed it to enter into the pantheon of mathematics, just because it was such a profound result. And of course, we're using the Pareto distribution. In fact, every day at the clearinghouse, we use the Pareto distribution to extrapolate out what large losses might be for our clearing members in the event of non-performance. In fact, we make them set aside capital based on our calibration of the Pareto distributions of their extreme losses. And it's also, it's a distribution that gets used a lot on the actuarial side as well. So it's not just a theoretical result, it's also an empirically useful and interesting result as well. All right, I want to turn now to statistics. And statistics is distinct. Well, formally, it's distinct from probability in the sense that it has a different classification. It's actually 62 in the 2020 scheme. And it's kind of interesting that you could imagine things having gone differently and saying that statistics and probability maybe were kind of competing with each other for legitimacy. And the fact that that both are now separate legitimate subjects, I think is itself interesting. And I think that a lot of that has to do, well, frankly, a lot of it has to do with Ronald Fisher, who's a problematic character in retrospect because he was involved in eugenics program in the UK, and I think at some point we're going to have to deal with that. But the point is, it doesn't change the fact that he was also extremely influential in the late 1800s, early 1900s in bringing statistics as a practice, ultimately into the realm of mathematics. And I think that a lot of it had to do in the beginning with his sort of careful thinking about what it is that we're trying to do as statisticians. And not so much statisticians that have been handed a data set and told to make sense of it, but as statisticians who are working directly with scientists to figure out how to answer questions about the physical system or the industrial system that they're trying to. Ronald Fisher was the person who came up with the idea of the null hypothesis. Prior to that, you could obviously, again, going back probably to the Egyptians, you could take a data set and calculate its mean and say, well, if the observations that I'm making are all sort of noisy observations of something that's in fact static, then the law of large numbers means if I take a large enough sample, I can get arbitrarily accurate mean. But he said, okay, but what if we can't measure exactly what we want? What if we have to measure things that are merely adjacent to things that we want, and we're certainly not going to be able to measure enough of them to be able to sort of blur our eyes and say that the mean is in fact the correct result. So what exactly is the sample size that we need? What are the measurements that we should make? So this is this concept of experiment design. And let me give you an interesting example of experiment design within finance. So this is a sort of little known fact, which I found a little bit frustrating when I was working for the investment management company. If you were to do an experiment design around whether one fund manager was better than another fund manager, one of the natural metrics that is used in CFA land is the Sharpe ratio, which is the ratio of excess return to standard deviation. It's standard deviation of, well, they call it tracking error, but it's the standard deviation of the daily return versus some index. It was actually Fisher Black back in the 70s, I believe, 79 perhaps. He did a careful study from an experiment design of what's the statistical problem. What experiment would you have to put together if you had two funds and you wanted to determine whether the Sharpe ratio, the difference in the Sharpe ratios measured historically between these two funds was materially significant. In other words, to the point where you would decide to advise your clients to buy one fund versus the other fund, which of course is what people claim Sharpe ratio that is for all along. And he determined that it would take approximately 10 years of historical data on a single strategy to be able to tell whether the Sharpe ratio on a fund was materially different from zero. So, a mathematician working in an investment management capacity would say, okay, well, obviously we could measure Sharpe ratios, but there's no point measuring Sharpe ratios because there's no way that a Sharpe ratio would end up in any sort of experiment design or any sort of a decision that we would want to make. And obviously there are lots of people out there that are still marketing based on Sharpe ratios. And I find that sort of, profoundly galling because, every mathematician who thinks about this for even a little bit or runs into Fisher's paper would know that that's kind of pointless. So this is what I mean by mathematics helping to organize ideas to create lasting value for clients. So going back to the topic of statistics, probably the contribution that sort of puts statistics on the map as potentially a mathematical subject is the concept of maximum likelihood estimator, which really came from thinking mathematically about estimators as functionals. So rather than thinking of the estimator as the estimate, so it's pretty easy to say, okay, well, the estimate is the value of the estimator, and the estimator is a function of random variables. But if you think of the estimator itself as being, a selection process of estimators, and abstracting to think about what should be an estimator, then you get into the sort of the area where you can think from an information theory standpoint about extracting knowledge from your data, and the maximum likelihood approach, which I think probably was attractive to him just from I would say aesthetics point of view. I don't know that he understood, at least not initially, the connection between the maximum likelihood technique and information, and that was going on. The early days of information theory. I mean, we see the connection now. We see it now in terms of the Cramér-Rao lower bound relating to something called the Fisher information. So, we're sort of in retrospect, we're seeing these connections. But the idea that there was this way of thinking about analyzing not just data, but analyzing the functions that analyze data, and then coming up with ways to design them. I think that was what made statistics interesting to mathematicians. And of course, now we go even further and we say that when we look at the functionals associated with estimators, those functionals themselves have certain properties, so we can analyze them, for example, by taking a Gateau derivative with respect to an impulse. And that turns out to be a very interesting way to develop an explicit notation of robustness. So if you want to know whether your estimator is robust to outliers, well, you take your estimator functional and you take a Gateau derivative with respect to an impulse, and you check whether it's bounded. We call that the influence function. If it's bounded, then your estimator is robust, and if it's not bounded, then your estimator is not robust. And you need to be aware that it's not robust because data can have noise in it, and sometimes that noise can be radically noisy. And we haven't reached the sort of end of that discussion. I don't think we understand robustness entirely yet. Certainly we don't understand robustness in a multidimensional setting. And I would say another angle, this was probably long after statistics earned its place in the classification, and that's the deep nature of statistical dependence, which we're still playing around with. In terms of what we call bivariate dependence, and I think that, most statistics students will understand the concept of correlation, and they may even understand the concept of correlation, the distinct concepts of correlation from a population standpoint versus correlation from a sample standpoint. And they may also understand that there are different correlation metrics out there that maybe are more or less sensitive to the margins of the data versus the pure dependence of the data. This whole idea that you can break up the analysis of a data set into basically univariate margins and a single compact dependent structure, which is called the copula. This was really made explicit by Abe Sklar here at Illinois, I believe it was, not that long ago, less than 100 years ago. And Maurice Kendall, as I said, who I think was a British mathematician, he came up around the same time frame with an estimator that turned out to be looking at the same quantity. I mean, I think that the frontier now is that it turns out that dependence is a lot more complicated potentially than just pairwise dependence. There's actually a lot of physical phenomena and phenomena in the finance setting that are probably better represented by dependencies that are more complicated than pairs. So you could have a situation where a whole cluster of companies, for example, might have stock prices that move together in some way under certain circumstances in a way that is not well explained by their individual pairwise dependence. And the idea that pairwise dependence is not the, is not the whole story, I think is sort of, it's a very provocative one to many people, particularly those of us that went through stats classes, in the last 40 years. So I think we're a long way from understanding the full consequence of Sklar's contribution. And I could give an example there of a classic trading strategy called the dispersion trade is really based on this very much. And of course, the biggest example of not understanding dependence and making a fool of yourself is the Gaussian copula in CDOs, which got blamed probably unfairly for precipitating the financial crisis in 2008. All right, finally, I want to touch on information. So information, which is a more recent subject classification, initially information was sort of the territory of electrical engineers. So it was the idea, and it all came out of kind of the radar groups. It was this whole idea. I mean, I guess it probably went back to telegraph as well, but it all had to do with transmitting information, transmitting messages. So what is the theory for encoding and recovering digital messages in secure, noisy, lossy, or lossless formats? And the early sort of theoretical work on this was probably Claude Shannon with his initial notion of entropy and trying to understand limitations on channel bandwidth. If you have a noisy channel, what's the maximum amount of information that you can pack into it? How do you know? And then, another sort of side question is, if you know that the channel is noisy, how much redundancy do you have to put into your message such that you can recover the errors with a certain probability, for example? So there was a lot of sort of interesting theory that I have to admit I don't know a huge amount about. And that's, to be honest, that's not really the part of information I'm interested in, but I think my interests are changing a bit as well. In fact, I've started to, in the last 5 years, I have started to learn more about the original information concepts, because my last point here, that there's a strong connection between filtrations and information, in the sense that the filtration of a stochastic process can be thought of as a noisy signal. So what can we learn about applying sort of entropy and bandwidth concepts to the filtrations that we observe, for example, in securities markets? But the area that I think certainly piqued my interest is, before this later idea, was the contributions around relative entropy from Solomon Kullback, Martin Leibler, and people like that, who discovered a sort of deep connection between entropy and probability, also in the context of dependence, because we're talking typically about conditional probabilities here. So I think that there's a lot to, I mean, one of the interesting things about information as a topic is that the fundamental concept, the Shannon entropy, is actually ill-defined. So there's an issue in that to calculate Shannon entropy, you have to take the logarithm of a quantity that has dimensions to it, and there's no meaning, there's no interpretation of that, and that's usually people will say, well, that's okay because we're not really taking the logarithm of the quantity, we're taking the logarithm of the quantity relative to some unit length. But then you could say, well, are you saying that the information now depends on some arbitrary choice of unit length? So it's pretty clear from my standpoint that we don't really understand even the basics yet of entropy. And we're going to presumably have to figure that out because it's now an official classified topic now, and it's got some gaps. So I think that's actually quite interesting. And I'm certainly not the first person to recognize the connection between information and filtration. I imagine that many of the automated trading algorithms are designed to extract the entropy from signals coming from the limit order book as well. One area that I think is a little bit notable, and this may expose my own interest rather than, well, I don't know. This one's a little bit edgier, and that's this notion of information and its connection to category theory, which is a much more established subject within mathematics that we absolutely do not teach. In fact, I was going to hit up the program director at some point about doing a module on category theory, but I don't know whether I'll be able to convince them that it's justified. There's been a lot of interesting work in the last 50 years by people like Robin Milner, David Spivak, John Baez, looking at what category says about the nature of information in general, which is called ontology. And that has had some influence on both the design of programming languages and the design of database systems. And there's sort of better ways to think about data and entity relationships that are not just more compact, but more sort of complete, that I think at some point we'll be able to apply category theory and some of the more powerful results from category theory to tease these out. So I think that there's opportunities for mathematicians who understand category theory to bring that to practice. In fact, I think that ultimately the issue with Bitcoin is a failure in understanding ontology. So let's talk quickly about Bitcoin. Bitcoin is built on top of something called blockchain. Blockchain is essentially a technology for database. The theory with blockchain, the motivating theory of blockchain is that you can set it up in such a way that there is no authority, that multiple people can own copies of the database, and there's a mechanism to accept changes of the data in that database in a way that everybody would agree to, even though there's no central authority. So this is called a trust-free implementation. And the idea, the sort of interesting idea out here, which the industry is still exploring, is if you were to have a trust-free implementation of a database, then is there financial value associated with the entries in those databases? So if you can create a virtual scarce resource, economically, any scarce resource should have a value, and therefore we sort of infer this concept of a crypto asset. And this is this is for any blockchain. It's for any scarce resource should theoretically have a value. So if you can if you can essentially materialize something on the internet so that there's only one of it, and everybody agrees that there's only one of it, and everyone agrees who the owner of that one thing is, then that thing should have value. Now, in practice, the trust-free aspect has been elusive. People have used blockchain concepts, but they've used it in a sort of private walled garden point of perspective. So fundamentally, blockchain is still a database, and it's being used as a database with trusted authorities. And it's being used today in that regard. There's a number of systems, such as systems relating to the paperwork for international shipping that uses trusted networks of blockchain ledgers. Bitcoin, in contrast, was and is a public blockchain, with the only exception to the no authority concept is that there's still source code control, but there's no authority regulating the activity of participants or blockchain validators in Bitcoin. Now, Bitcoin was named after a currency, and I think it was sort of marketed as a currency, but ultimately it has failed as a currency in the sort of economically well-defined sense of being a medium of exchange, store of value, unit of account. And and I think there's a sort of reason for that failure. What Bitcoin is it's still a crypto asset, and in fact, the CFTC recognizes it as a precious commodity. So CFTC regulates Bitcoin almost as if Bitcoin were gold. So there's nothing preventing an American from owning Bitcoin or from trading a Bitcoin, but with respect to trading, the opportunities are more OTC. There really isn't a futures market for Bitcoin, because Bitcoin is essentially behaving like a precious metal, and it probably is going to remain that way. I don't see how it can overcome the fundamental problem, and the fundamental problem is that the ontology in the Bitcoin world it explicitly excludes an authority to resolve the issue of the incompleteness of contracts. And I think that that's where I'm proposing that it's about a stronger understanding of the ontology. It isn't just an assumption in the design. Obviously, it's a flaw in the design, but I think that we could have known that there was a flaw in the design just from looking carefully at the ontology model. And this is actually the idea that there's the fundamental flaw in Bitcoin is related to the incompleteness of contracts. I should attribute to Katharina Pistor at Columbia University. And I have three particular examples, which I think I'm going to buzz through, about how Bitcoin has failed in this regard. One is the issue of merchant chargebacks. Because there's no authority able to impose an edit on the blockchain without going through another expensive validation, there's no way that if a merchant makes an error, someone has to pay to fix that error, and that that's a huge impediment to its use in the retail setting. I think people are fine to do high value transactions involving, basically an illiquid barter. But if you're doing a low value transaction and you have no way to edit the transaction costlessly, that's going to be a huge problem. Another failure sort of adjacent to Bitcoin is with Tether. So Tether was intended to be a sort of mechanism to connect Bitcoin to dollars directly, with the idea that Tether was meant to be a trust certificate for USD. But the Tether authors essentially refused to cooperate with trusted authorities in the sort of USD world, and it became a problem, pretty quickly after Tether got started, that people started to doubt whether the trust actually existed, whether the USD that the Tether designers said would be there was in fact there. They weren't willing to prove that the USD actually exists. And it actually got to the point, when there was like literally billions of US dollars equivalent of Tether outstanding, it got to the point where it was like, well, you can't literally hide that many dollars without any regulators knowing. So people began to wonder whether the trust even existed. But whether or not the trust exists, I mean, I personally think that it doesn't exist. I suspect the whole thing was a fraud from the beginning. That's neither here nor there. It doesn't. I'm not an investor in this. The point is that investors who are using Tether as a vehicle to access Bitcoin or whatever, at this point they now have to discount because they don't know whether it exists. And also, not only do they not know, but they also have to take into account that their counterparties might not know. So it gets you into this sort of spiral of discounting. And again, this is because because of contracting completeness. And of course, the third big example of incompleteness was around the 1 weak point of Bitcoin, which was the source code control and the Bitcoin Cash fork, which was a situation where, since there was no authority to impose a standardization around a code change that was made, there was a faction that broke off and decided to stick with the old code. So essentially, Bitcoin ended up forking into 2 different versions of Bitcoin that all had different validators and different blockchains. Prior to some date, they were the same, but after that date, they were different. And that's obviously very problematic from a cash standpoint. So the lesson that I sort of took from all of this is that, database technologies are database technologies. And just because they exist, as I said before, people are going to continue to create technology, particularly information technology, because it's so easy to do. But just because it exists doesn't mean that it's useful. And I think that if someone had thought more carefully, I mean, I don't know whether the intention was for Bitcoin to ever succeed, but if someone had thought more carefully about the design, maybe they could have come up with a version of Bitcoin that actually did work as a currency. All right. It looks like I've run down my clock. I'm really sorry about that. I may have to skip the big data discussion. The main message that I wanted to convey with respect to big data is that the needs for distributed computing have really changed. In the 80s and 90s, we had to do distributed computing because of technological limitations. In the modern era of 64-bit architectures, the need for distribution has really disappeared. And if you define big data, as I do, as data that is so large that it has to be analyzed across a network of computers, I don't think that really there's anyone doing distributed statistical or data analytics. And I think that there's a reason for that. And I think it's here. And again, this is something that any mathematician familiar with statistics could have predicted. When you're looking at real problems in statistics, the underlying model is probably going to involve either exponential families or hidden states. An exponential family is, almost all the distributions from textbooks are in the exponential family. And then one of the interesting things about exponential families is there's a result out there called the Rao-Blackwell theorem that says that any estimator for a parameter or mixture of parameters in an exponential family can be improved by conditioning the estimator on what's called a sufficient statistic. And it has the effect of reducing the dimension of the problem to the number of sufficient statistics. And the interesting thing with Rao-Blackwell is that for an exponential family, you can prove that the number of sufficient statistics eventually converges. And it tends to converge to something quite small. So even if you have a large data set, the actual number of sufficient statistics you have is probably less than 12, probably less than 10, in many cases 2 or 3. And that's not big data. I mean, yes, it might involve some distribution to calculate the sufficient statistics, which is just a simple, database query, frankly, for each one. But once you have the values of sufficient statistics, the actual fitting exercise is going to be some complicated nonlinear exercise that you're going to end up doing probably single-threaded on a single CPU. And hence, it's not distributed. The other sort of branch in this is going to be data involving hidden states. And hidden states are fairly ubiquitous. Any non-Markovian process involves hidden states. And we see it all the time when we're trying to estimate the dynamics of Garch-style processes. And the problem with Garch-style processes is that the underlying unconditional distributions are no longer in the exponential family, and therefore the number of sufficient statistics essentially grows with the number of data points. So you have essentially an exponential crisis. And my point here is that it's then futile. At some point, to do anything to estimate, for example, data from a Garch process, you have to make an assumption about the nature of that process. And once you've made that assumption, now you're back into the exponential family situation. And I think this is why big data is no longer relevant for computational finance. I'm sorry, for scientific computing. I think there is still a domain, just as there's still a domain for better database technology. There's still a domain for big data, but it's not going to be for scientific topics. Scientific computing is not going to be for statistical analysis. That's just the way it is. Okay, let me just quickly go through the roles for quants, and then we'll open it for questions. So Harvey Stein is a long time, he's a senior guy at Bloomberg. I've known him for a long time. He had this very, very interesting theory, which I'm going to convey here. He said that the history of the quants began with the Berlin Wall and Tiananmen Square in 1989. And in particular, those two events essentially closed off academia as a career track for an entire generation of Western STEM graduate students. And I think that in retrospect, I probably was a victim of this as well, because I certainly wasn't headed to finance in 1989, and yet I have now 30 years of finance. Now, there was still finance going on prior to that. In fact, back in the 80s, O'Connor and Associates was beginning to use Next computers to do equity option market making. So I think that there were what I'm calling the pioneers out there in the 80s, but it was really the sort of wave of STEM graduates in the 90s piling into interest rate derivatives that kind of defined the field. And then once they had sort of swamped LIBOR, they started to get into securitization, including CDOs. They started to get into derivative counterparty risk, as the banking system started to fall apart. Then they started to get into liquidity risk and contagion networks as the mortgage crisis unfolded in sort of 2008. And by the end of the decade, that whole world had disappeared. Nobody was doing swaps. Nobody was doing securitizations. And all the quants got laid off in those areas and got rehired, a few of them, in the 2010s doing stress testing and model validation, which was kind of the fashion. That was the pendulum swinging back. The regulators looked at the crisis and said there were errors in models, and there were errors in the way that banks were organizing their business practices with sell and distribute model, and we needed to do stress testing and model validation. That was their sort of proximate cure, which of course it wasn't. And by the end of the decade, the regulators had moved away from stress testing, and most firms had outsourced their model validation. So the fact of the matter is that banking is really no longer a net employer of quants, I would say. On the other hand, non-banking, and by which I mean private equity, lending marketplaces, payment networks, central clearing, and crypto assets, is still hiring to some extent. And I think that the main roles, which is what I said in my talk for orientation, are in sort of performance and exposure measurement, model library maintenance, desk quant roles, documentation roles. And I wanted to close with a quote from Gary Sobczak at Chicago Trading. He said, at the entry level, you either need to be able to write good papers or you need to be able to write good code. And I think that still sort of typifies the opportunity set for recent graduates. So I'll open it up for questions.
Thank you, John. That's excellent. Looks like there's a couple questions here that came to me privately. I'm going to read the second one, which I think is kind of a two-parter. But the person who asked it can jump in if they like. So comment on smart contracts and the role of proof-driven security that could address the issue. There has been a DARPA-funded program for 5+ years on this aspect, formal verification. I know a professor at Yale that has a lead on this. And entirely math-driven verification, is there processing overhead to develop within the system?
What was the last part? A what developed?
Is there, there is a processing overhead to develop within the system. Maybe.
Well, yeah, I mean, I think the right answer is to, again, look at the ontology, in particular in the entities, particularly around the topic of resolving issues with the contract. So, I acknowledge that there are crypto assets, at least until quantum computers can break all the codes, in which case the crypto assets disappear. But at least while we have codes, there are crypto assets. And those crypto assets could have, they could have conditionality to them that are valid. For example, there's no problem having a futures contract on Bitcoin, in Bitcoin, cleared in, completely sort of endogenous to the Bitcoin universe. The issue is when Bitcoin wants to interact with the real world. So I think when you talk about smart contracts, as long as those smart contracts are playing with each other and only with each other, it flips a coin and decides whether it's going to give out this many ethers to this guy or this many ethers to this other guy. As long as it sort of exists within that virtual reality, as long as it exists within its own, it's going to only exist within its own ontology, then it's fine. As soon as there's a contract dispute, that's going to introduce a friction. And it all depends on the use case. So in the case of Bitcoin, the use case, for example, around merchant chargebacks was that a merchant needs to be able to say, oops, the customer gave the wrong credit card, or something happened and we need to reverse this transaction. And as long as there's some mechanism, so whoever designed Bitcoin forgot about that case and said, oh, we need a mechanism for a merchant to be able to costlessly reverse any transaction, worth less than $100 or something like that, or less than $1,000, because the customer's always right. That's what the merchant says. As long as that is envisioned, then Bitcoin had a chance at functioning at the merchant level. If the contracts are simply looking after the paperwork on ships, then contract resolution there. There's a little bit of contract resolution there, but it's sort of understood how that works, and there's probably a way to kind of pop out of the blockchain ledger and fix things that is perceived as just. But I don't think that. I think it has to do with understanding the ontology. I don't know if that answers the question. If there's a follow-up, go ahead and unmute that person.
I certainly welcome. There is a follow-up question, but I want to make sure that because we're a little bit past time, I want to make sure that anybody else who wanted to ask a question had the opportunity.
Well, I just have a quick one. So, John, you mentioned the Sharpe ratio, and I agree with your view on that one. And I want to ask, are there any good mathematical tool or technical tool in general that you particularly liked when you were in the investment management business?
So I think understanding dependence is really interesting and rich, and there's a lot of very smart people who have thought about that. So when you think about, for example, risk management, or if I'm in the setting of the person who's being asked to use Sharpe ratios, it might be that what I should be looking at is whether there's patterns in returns that suggest a hidden dependence, and focusing on that. Or maybe that, the main assumption in the proof about the experiment design for Sharpe ratios is the continuity of asset prices. So you could have a situation where some underlying assets are in fact discontinuous, and then so if you have sort of gaps, so maybe a careful study of the extreme movements, and a careful study of the co-movements in some sort of a robust fashion would maybe give you a better way of constructing, potentially diversified portfolios, rather than, say, focusing on Sharpe ratios and alpha. Because I think that's really the warning, is that the sort of, there's no point measuring means and variances. You have to look at something else.
Okay, thanks.
Thank you. So another question, which you've seen to the larger group, which is, do you have any recommendation material for category theory?
Oh, yeah, I would, I might start with, there's actually there's an effort right now, I think it's out of MIT, it might be Princeton, I'm not 100% sure, let me go back to that page. David Spivak and his colleagues are writing a text right now at MIT, most of which is online. So you might want to start with him. Robin Milner is he is a previous generation. He was very interested in writing code that would never crash, and so he was interested in this robustness idea, and he applied category theory to create a computer language that basically was so hard to compile. You basically had to solve every possible contingency to get it to compile. And once it compiled, it was essentially guaranteed not to crash. And there are companies out there like Jane Street Capital, for example. They're the people that made all the money off of the XIV default. Jane Street, I don't know whether they explicitly use Milner's language, but they require all of their people to know Milner's language. They use it as almost a filter. It's like, if you think Milner's language is cool and you can prove it to us, you can come work for us and make a ton of money. But I think they actually have some of their code in ML. But it's the situation where it's basically a theorem prover. You basically have to prove to the computer that your program is correct, and then it will compile it, and then it will never crash.
So as long as we're talking about computers, I'm going to go back because you mentioned quantum. What's your view of its impact?
I don't know. I'm not sure what to say. I mean, I think there's a lot of money being spent right now. University of Chicago is one of the participants, along with Google and I forget who else, in a federal project to basically monitor the quantum crypto space. The problem that that the finance guys are afraid of is that if someone starts breaking the codes, it's not obvious that we would know. So the question really is, how do you detect that someone has broken the codes? I don't think that, I mean, I'm sure there's people also working on breaking the codes, but I think that's a secondary problem. I think the primary problem is defensive. How do you know that the codes are no longer secure?
So with that, because we're at 37 past, I'm going to stop the recording. I'm going to thank John again. I wish everyone give him a great thank you. We usually try to post the video and the slides, so we'll probably have those up within the next few days. And I'm going to stop the recording.